property matters now. Last month's pause in interest rate hikes provided some relief to the rental property market. That's according to the latest TPN Residential Rental Monitor report. It says demand for residential rental properties has been growing steadily. So industry principal at TPN Credit Bureau, Waldo Marcus, joins us this afternoon to share some more insights on the report's findings. Very interesting, Waldo, that we did see a steady uptick, if you will, in the interest in residential rental property. How does this fare compared to people who might be looking to purchase properties? What were some of the trends that you saw in the rental property space compared to what you would have seen when it comes to people interested in buying?
Good afternoon, Rafiwe. Thank you very much for having me on your show. Yeah, the residential rental market has been very buoyant since the lockdown restrictions were lifted. We've seen national vacancies drop to 6.19%. The TPN rental market strength index sitting at 9.16 points above equilibrium, meaning that the perceived demand is outstripping the perceived supply within property professionals. So it's really showing that there has been a move from those looking for accommodation from purchasing, which we saw really good residential property transactions taking place in 2021 when we had lower interest rates. And now what we're starting to see is a big demand for residential rental properties. And that has really pushed up some of the escalations that we've seen in the past couple of years. However, what we're starting to see right now is with consumers being under huge pressure, we're starting to see a slight decline in the number of tenants in good standing, which we expect to continue, although it's lower than what we see in other credit good standing. We're starting to see the consumer, especially within the residential rental market, is showing fatigue in the industry.
Yeah, and I mean, that is an important point that I'd like to pick us up on. Tenants that are not in good credit standing with the landlords, the risks that landlords are then exposed to when it comes to a tenant in this particular position because of the current economic climate. What are some of those risks there, and what do tenants and landlords have to consider here?
So we look at the national good standing, and in TPN's terms, a tenant is in good standing if he's met all its rental obligations by the end of the month. So they've paid their rental before or on the last day of the month. And we see nationally that the tenants in good standing is sitting at 81.86%. So that means that 8 out of 10 tenants are committed to making their rental payment commitments. But if we look at good standing, and I just look at the number of short-term credits, and people that have those access to that short-term credit, only 67% of consumers are in good standing there. So residential rental properties and the tenants is still paying their rental towards it. But we're seeing that in some provinces, for instance, in KwaZulu-Natal, only 75.82% of tenants are in good standing. Gauteng is sitting under the national average at 80%. And then we see, for instance, the Western Cape, where we're sitting at 86.78% of tenants in good standing. So what this means for a landlord is, although we're seeing good demand, lower vacancies, good escalations coming through, is that more and more tenants are struggling to make their rental payments. And understanding that the cost of living has increased, we've seen interest rates not just impacting the mortgage market, but any other form of line of credit. Fuel prices have gone up, inflation has been very strong, and that's placed households under pressure, and we're starting to experience that the tenants are struggling to make these payments. So for a landlord, it's critically important right now, although you have a demand for your property, is that you place the right tenant in the right property. And to do that is to perform proper background checks, make sure that they can afford to occupy your property.
Tell us about the different brackets, Waldo. I always find this interesting. Of course, we've got the lower to middle income all the way up to the luxury rental property market. How are those different brackets faring?
So we're seeing the lower end of the market. Those are tenants that pay 3,000 or less a month. Their good standing is unfortunately the worst, sitting at 67%. They equate to 13.9% of the market. So 13.9% of tenants pay 3,000 or less per month. 3,000 to 7,000 rental bracket value is sitting at 82.39%. So they are still performing very well. And that equates to 51% of the rental market. So half of tenants in South Africa pay between 3,000 and 7,000 rand a month. Then the sweet spot, and that's sitting the 7,000 to 12,000 rand a month. They're sitting at 87.62% in good standing. They equate to 15.6% of the market. So they are the best performing tenants. They are really committed to paying their landlords at the end of the month. Those paying 12 to 25,000 rand a month, that's sitting at 86.93%. That's 8.2% of the rental market. And then, as you mentioned, the luxury market, those paying 12,000 or more a month, only equates to 1.2% of the total formal residential rental market. And they're sitting at 81.06%. So they are the second worst performing, and the worst performing in terms of tenants committed to paying their rent is those that are paying 3,000 or less a month.
Very, very accurate kind of a picture of the state of the consumer in South Africa. Waldo, as always, thank you very much for joining us with that update. That is Waldo Marcus, who's from TPN Credit Bureau, joining us this afternoon.